Welcome everybody to today's 12 Days of Property. And we are joined by a phenomenal brain in Mr. Rod Turner. He runs the boardroom. Is it the boardroom experience, Rod? Have I got that correct?
The Boardroom Club.
The Boardroom Club, a serial property investor, well known within the Partners in Property community as well. And, well, a phenomenal businessman. Need I say more? So, welcome, Rod, and tell me, 2021, it's going to be a fun year, isn't it? It's a roller coaster, I think, we've got ahead of us. Twists, turns, ups, downs, fast bits, slow bits, hopefully no corkscrews. What do you think 2021 has in store for us?
Goodness. Well, thanks for that very kind introduction. I guess that's the million-dollar question. I suppose I'm going to give a real political answer of it depends, and not really answer your question at all.
Well, I think our audience would love to hear what is happening in the world of Rod and what Rod is going to be doing, where you predict the opportunities are going to come, so that people can go, yeah, I can resonate with that and get on and follow you on social media and perhaps get involved in some of your projects with you or bring projects to you.
Okay, so first of all, I think in terms of property, you've got to look at what property is and how it behaves in terms of an asset. And when we talk about property, it's a vast array of different things. So we were talking about real estate. You can have commercial real estate. Within commercial, there's various different asset classes. You've got house prices, rental prices, all these different things. So the first thing I guess is to work out what in particular you're talking about. So if we were to take something that most people kind of understand the idea of house prices, you look at how that behaves compared to maybe some other asset classes. And this is where I think people kind of can often get mixed up, because there are some odd reporting or views that come from a lot of the, should I say, higher value kind of asset managers when they talk about house prices. So what I've looked at is how house prices behave compared to some of these other assets. And when we're talking about assets, you can talk about cash, can be equities, can be commodities, gold, etc. So the way to look at house prices is very dependent on how you buy it. So if you buy it in cash, it behaves one way, but most people don't. And so I look at house price or house residential property, and especially in the UK, because again, in other countries it can act differently, and you're dealing with different currencies and other things like that. So I look at house prices behaving a bit like a combination of a commodity, because it has that real world use and everyone needs it, but also as a leveraged equity. So a leveraged stock, and remember, all stocks, most stocks and businesses will already have debt within those businesses. So people say, yeah, you can't leverage stocks. Well, that's because they're already leveraged, and you can, and if you go down sort of some weird and wacky routes anyway. So I look at it as a combination of those two things, and then I want to look at what are the possible environments to come in 2021 and beyond. And what I'd do is I'd look at, right, okay, let's look at the environment of the UK. I mean, the headlines are covered up with COVID and Brexit, and they're obviously the two major things. So if we were to take one of those things, COVID, well, what's the implication that's going to have on a market? Well, we've already seen this year house prices do particularly well. We've got, even within house prices, we've got stamp duty and things like that. Again, when we start now looking at things with all these different environmental factors involved, you can't just look at house prices in the UK as one market, because there's a huge array of markets. So when we're looking at it, it's important to kind of differentiate between those different markets, even within the UK, England. I mean, London has 3 very different markets in prime, inner and suburban. and they're very different. So every time you're looking at a market, it's looking at the location, the tenant type, and the use class. So, for example, it could be like HMO doing social tenants in Timbuktu versus a 2-bed flat with young professionals in London. I mean, they're two very different markets, and they're going to behave in very different ways. So, just to take, for example, the stamp duty changes. I mean, that may have an effect on lower value areas when it stops, but for 4-bed houses in most parts of London, the maximum saving you can get is 15 grand. So if 15 grand is the maximum saving you can get, and the average 4-bed house in, I don't know, suburban London is £1 million, buyers aren't going to be put off by that. And so I can't see that having a big effect on that part of the market. However, when you start to look at the saving you can get as a percentage of the property price in Oldham, for example, it's going to be a bit of a difference. So that may affect those buyers and what they're prepared to pay a bit more, and that could affect that market. So it's very difficult to kind of look at what's going to happen in anywhere unless you kind of pinpoint, right, what's going to happen to this market if this happens. And then we've got to look at all the things that can come along with COVID, with Brexit. So with COVID, obviously we've got unemployment is one thing. Now taking unemployment on its own, you've got to look at, well, where is the unemployment going to be? What locations? What job types? But more important than what job types, what's the average salary and value of those jobs that's being lost? So is it being lost in low paid hospitality, or is it being lost in financial services at a high value? And that's going to make a big difference. So are these people home buyers, or are these people renters? And what types of areas do they live in? And what possibly people will find is the levels of unemployment, although they're being pushed by the papers as kind of rocketing up to 5%, I mean, that's still under the average of the whole of Europe before COVID. So it's still not very bad. It's not that bad on the basis of things. The other issue with unemployment, and what we've had over the last 10 years, where it's been very low, is actually that really affects productivity, because the only way to get a more experienced or better quality person onto the team is to pay more, and you're paying more for the output. Obviously that squeezes productivity. So that again can cause an issue. So there's a lot of kind of things that come out in the press that focus on political kind of reasons that might not actually be all that they seem.
If I could zoom out for a bit, I don't think you ever sat down in a room full of people hearing my property cycles talk, but I think we did go through it in a hotel lobby once, kind of briefly. Zooming out at kind of the big picture, there is some value, I think, to be gleaned from that. And the two things that I'd like to say on that are, first of all, that people's behavior is a whole science in itself. There's a whole discipline of behavioral economics, which is where, you know, people are driven by what they read in the Telegraph or the Daily Mail or that kind of thing. And that's a great driver of sentiment. And the second point to bring in this point is that there is no discernible correlation in residential property between supply and demand because of this thing that you've said. It's a leveraged asset. And so
in other countries there is, though.
Oh yes, I'm specifically drilling down for our UK audience on UK things. And so here in the UK, when you map this out in graphs and charts, it's basically to do with mortgage availability, and there's this formula called mortgage credit impulse, which is the rate of change in the supply of residential mortgages divided by GDP, to put it in perspective. And there's a very, very high correlation. I think off the top of my head, it's something like 44% correlation between that, and yeah, there's a sort of 3 or 6 month shift on it, but between that and house prices in the resi market when you sum it all together. So that's another part of the picture. And
just on that point, remembering, like, when the markets move in other asset classes, they're talking about liquid asset classes. So the markets can move very quickly, because if I want to sell a stock, I can do it there and then. Whereas if I want to sell a house and the market's gone downhill, it's very, very difficult for me to actually make that sale happen, and can sometimes take up to a year. And by that time, the market might have started to move. So it's very, very different. Again, trying to compare liquid assets to illiquid assets, especially when illiquid assets become more illiquid when there is movement.
And you see, in a place like here in Cambridge, when the market goes down, people are financially able to say, well, I'll just take it off the market and wait 3 years. And that is indeed what happens. So there are many factors at play.
That's what happened in 2008 in London. Property prices, house prices, fell by 2%, but property values fell by a lot more. And there's a major difference between a property house price, so the sales price, and a property value, which is done by possibly a RIC surveyor or whoever for the mortgage lender. And then just on your point of looking at the mortgage to GDP metric, one of the really good ones that I like to look at, which has been very useful for me so far, is looking at affordability, but in two parts. So you look at that, this is just for house prices, I should say. So you're looking at that upfront affordability, and that's based at the moment on things like stamp duty, legal fees, and your deposit. And you can look at that as a multiple of your annual salary. And then the second part, which is at the moment more important, and it's more important because leverage takes a bigger toll than the upfront costs, and that is the servicing of your mortgage as a percentage of your income. And what you find is, because people are more highly geared, because interest rates, because the length of mortgages change, that has an effect on this metric. So if you look at going back through every house price crash since mortgage data has been available, which I think is the late 70s, or every correction even, what you find is that that second metric goes over a threshold. So for example, in London, that might be over sort of 65%. So 65% of someone's monthly income will go on their mortgage servicing costs. Okay, that's a breaking point. Whereas in the rest of the country, it might be 50%. And the reason London is different, and with London, you can put certain other areas in, higher value areas. And the reason they're different is because the staples of living, so everything else that's needed to live on, so food, transport, internet, things like that, now clothes, are relatively the same where you go in the country. So that's going to make up the similar pot. So people will spend more, and that does sort of do a good job as a good metric to kind of follow in conjunction with lots of others, as I'm sure you know. But yeah, so going back to kind of Andrew's initial question.
Well, a long time ago. But before you do, post Brexit. So I could just, sorry, Andrew, I'll shut up in a second. But post Brexit, of course, this distinction between London and everywhere else has diminished because we're all working on Zoom like we are today.
Yes, I think you're right in a way, but I don't see that lasting. I mean, I'm in London, and speaking to other people and going to the city, going to the West End. I mean, the city is a very strange place at the moment. The West End is, I don't want to say back to normal, but it's on its way. It's on its way. People are going back into the office. People are very, very keen to get back into work, especially younger professional people, financial services. They're very keen to get back into the offices. And it's very dependent on where people, or not where, but what people live in. So are they in a shared house? Are they in their early 20s, and are they living and working in the same room? They want to get in. The biggest barrier to stopping people wanting to go in is how they get to and from work. And if they've got to get on the tube at rush hour, that's a major put off at the moment. And I'm talking London specifically.
Is the employee driving this, or is it the employer? Because we've got to remember, for the employer, their second biggest cost is that square meterage.
Well, yeah, it is. I think they're both driving it. From the employer's point of view, I think they're finding it very hard to build their talent base up when you've got young people that are trying to learn a role, and that you've got a lot of roles, especially in, I keep talking about financial services just because it's the biggest industry, but in that you need to shadow people. You need to understand how they communicate with people, how they deal with different issues that come up by watching. And you can't always do that over Zoom. And I think people are realizing that. And I think if you had spoken to people kind of 6 months ago, they were keen to get out of London maybe, and they under the understanding that they might be coming into London 1 day a week. If you speak to people now, I think their mindset has changed, that actually, yeah, well, we have to come into London probably 3 days a week. And although it's still not the 5 days a week, it's, well, actually, being 2 hours away is no longer a reality. And I think that's a major shift. And obviously, I'm generalizing massively, but you've got to, looking at what I'm seeing, I am seeing an awful lot of that. And I'm seeing people keen to get back into the offices, dependent, obviously, on what their jobs are and what they're doing.
If you've been affected by this, drop a comment below, because Rod's been a little controversial there, that you're either going to come into the office or you're not going to want to come into the office. I've seen very similar, and I can relate to what you're saying, Rod. So
yeah, I don't know if I'm saying you either or, it's in either or. I mean, from my point of view, I would like to be in an office probably 2 days a week would suit me perfectly with what I do. And other people, it might be 3, it might be 5. I mean, if you've got 2 screaming kids at home because primary schools are now shut, I think I'd want to be in there 7 days a week. But it all depends on people's personal situations, I think, and the space that they've got involved. And also, look, it's all well and good saying you have more space in a certain location, but it's not just about the space, it's about interacting with other people on a human to human level as well.
Yes, as a final point for me, in terms of my context that I have, the people who have been most happy working at home, and I don't know whether there's any significance to this or not, are the people working in IT. They seem to think it's terrific.
That's definitely not me. I'm terrible with IT. That might be why.
So Rod, I mean, we were looking at the year, the highlights, the opportunities. I mean, towards the back end of last year, you were involved in completing a couple of fairly significant transactions. Now, do you see 2021 as being beneficial for them because of planning white paper changes, permitted development changes, or opportunities elsewhere in terms of asset management? I mean, how are you sort of predicting that the year will unfold? More opportunities like you saw, or a tougher ride this year?
I hope so. I mean, we went ahead and bought those deals because we felt confident in what was going ahead. Again, it depends what it is. It's very, very, it's difficult to talk about things as a whole, as you know. But I mean, my outlook, I'm quietly confident. I'm confident certainly on London, which many people might not be. And again, in London, it's looking at what parts of London and what exactly. On flats, probably not, unless they've got nice big gardens and are quite spacious. But I mean, if you look at prime London at the moment, prime London has gone through the longest recession of house prices, I think, in the last 50 or 100 years. It's been 76 months of downward prices, which is unheard of. When you look at things like foreign money wanting to come in as well, you've got to look at, obviously, COVID has played a big part in the fact that supply and demand. So you've got a lot of prime London was either people's second homes, and now they're not visiting because of COVID. You've got Airbnbs, and the amount of Airbnbs in prime London is absolutely huge. And they've all gone back to AST, so they've flooded that supply on the rental market, so that's driven rents down. You've got foreign students that make up a lot of occupiers, in that prime central London, especially in the apartments as well. They've stopped. So I kind of look at it as when that comes back, I think a key thing is when people are able to travel again, suddenly you're going to see London start to really zoom off again. And I think I'm quite positive on that side of things, really. Again, that's very dependent on if and when, and hoping kind of vaccines and airlines and things like that do kind of come to fruition on that a bit. But again, yeah.
Well, I can say I had my vaccine a couple of days ago.
Oh, wow. Congratulations.
Some cancellations with the GPs, and I was invited to use one up before it went in the bin.
Well, those over 80s, Andrew, do get priority, so age before beauty, you know.
Well, thank you, sir. Thank you, sir. But no, it does make you, it doesn't make you feel safe or invincible, but it makes you feel, hey, normality's starting to come. And if we hit the target of 10 million by March being vaccinated, and the cohort that's been unfortunate enough to contract, it does start to mean that the population starts to return to some form of normality.
Did they tell you which vaccine it was, as a matter of interest? Pfizer or AstraZeneca? Oh, Pfizer, okay. So all good. And yeah, this new strategy, it's a bit of a sidetrack, but
yes,
there will be people watching who are interested in this kind of thing. This new strategy of not vaccinating after 4 weeks is a good one, because in fact, there's the most data about this is on the Oxford AstraZeneca one, but by leaving it 12 weeks, okay, you might catch it, but you're very, very unlikely to get the serious consequences of it. So it's a good way of rolling out, 10 million doses or whatever by Easter.
Yeah. And it's more, they found that out by accident, didn't they?
Yes.
Yeah, it's quite good.
Serendipity. So with penicillin and a piece of cheese.
Yeah. So, Rod, I mean, taxation, that's always everybody's favorite topic. We've had extraordinary quantitative easing, and you were sort of alluding that in 2008, RICS valuations were showing house prices were actually increasing, but in real terms, because of quantitative easing and the pound in your pocket was actually buying less, it was inflating.
Do you know what? This is such an interesting topic, and funnily enough, I put a post up on, I can't remember what it was on, in I think it was June or July, about currency, devaluation of currencies, what that meant for property. And as an example, I put up a graph of gold compared to property prices, UK house prices. So UK house prices, how many ounces of gold it took to buy house prices through the last 50 years. And actually, if you look at house prices being bought by gold, then house prices have gone down in the last 50 years, quite considerably. And it was to kind of highlight the fact that, look, value is not just about how much money something is, because there is a value of money as well, of the currency. So this kind of opens up, I don't know, hundreds of different kind of topics and points to discuss. But I would just say on this, people need to, one, be aware of the different markets like we've spoken about. Two, be aware that quantitative easing does not mean inflation. And three, it might do, but it doesn't necessarily. And three, remember that inflation comes in different forms. So when typically we talk about inflation, we're talking about CPI, you could be talking about wage inflation, or are you talking about asset price inflation? And then, yeah, there's lots of kind of different scenarios to discuss on that. But yeah.
I appreciate it's a can of worms. So we'll park the quantitative easing element and the inflationary effects on asset classes or not. Taxation. I mean, Rishi Sunak has put his hand in his pocket very deeply and printed a lot of brand new banknotes, which is partly to keep us in parity in our exchange rates, in parity with other nations, but also to keep the economy afloat. Do you think that will be repaid and cancelled out through taxation, or do you think the cash will stay in the economy like it has since 2008?
I don't think it will ever be repaid, but I also don't think it will be defaulted on either. So what I mean by that is I think it's just going to be kicked down the road. And yeah, I know you had Adam Lawrence on this, and I think back in February I had a panic kind of call with Adam about what we thought was going to happen, and I think I remember us saying, I said to him, do you think this is the end of the Ponzi then? Is this the end of this big Ponzi where people keep doing it? And we came to the conclusion that, nah, it's got one or two more sort of crashes left in it. And I still think that. And I'd love to think that, okay, actually what the government might do is not raise taxes hugely for certain industries, but I think politically they're not going to get away without raising certain taxes, and you've got to look at what the easiest ones are to bring in money, and the easiest one would be to do it on kind of the lower income, because that gets everyone, but politically it's a bit of a tight one. So what are they going to do there? I mean, he's already said that they're looking not to do any tax raises until 2022. So to give everyone a little bit of kind of breathing space. But again, I suppose it depends. And the other thing that should give people comfort in a weird way, because a perverted way almost, is that this isn't just the UK. This is pretty much everywhere else. So when looking at things, and this is what I often sort of say to people when you're talking about investment deals and, oh, is this a great deal? Don't compare it with deals of the past. Compare it to what else is available to you at that particular point in time. So you can't compare yourself to someone who's got billions of pounds and what deal they're doing. And likewise, you can't compare to a deal you did 2 years ago when the environment was different. And I think it's going to be the same with the taxation issue. If taxes are going up here, but they're also going to have to go up everywhere else because all these other countries are trying to do the same thing, then it's looking at, right, well, how does this compare to elsewhere? Because what we don't want to do is to encourage other people to bugger off somewhere else to start up and make these places productive without us. So, yeah.
That brings us into an interesting point. I mean, off the shores of the UK, we've got Jersey, Guernsey, Isle of Man, which are deemed to be tax-free havens. Now, do you think that the United Kingdom might become a tax-free haven of the United States of Europe?
Well, not anymore because of Brexit. But I mean, God, that would be.
You get what I mean in terms of businesses choosing to domicile here because our taxation is preferential to Europe.
I think that when the whole kind of Brexit thing started, a lot of people thought, wouldn't that be nice if suddenly we said, you know what, corporation tax will go to 5%. Let's encourage businesses to set up here and become a Delaware of the US and things like that. But I can't see that happening at the moment. More politically than anything else, I think it would. I think trying to convince voters, and this is the thing with politics, it's all about what voters are going to do. So
yeah,
I mean, Ireland did it, didn't they? And they were part of the EU, and they got a rap over the knuckles. So kind of clearly they managed to convince their electorate.
Yeah.
But on the flip side of it, I mean, if the fishing boats and Macron keep insisting on occupying British territory, it might be a retaliatory thing to sit there and tweak taxation rates to make it attractive for them to all of a sudden re-domicile their boats to the UK.
I think also a big problem is looking at the UK's kind of population and where they're at in terms of where's the aging population going, what do the younger generation want to achieve, I certainly feel the younger generation are much more of a globalized population, and certainly, well, looking at the Brexit votes, they certainly didn't want it, and they don't want to be seen as an island on their own. And trying to get those voters round, I think, might be tricky. But again, this is turning into politics, and who knows what can
Absolutely, absolutely. I was putting you on the spot with an awkward question, and I wasn't trying to sort of get you anywhere awkward. I was looking at it from a taxation impact, and could that be something in our toolkit?
I mean, going forward in terms of, I mean, I know there's been things like the capital gains tax that they're discussing, and people are getting a panic about that. I mean, obviously they want to make changes, otherwise they wouldn't be commissioning the report from, I forgot what they're called, the budget of whoever it is.
Office of Budget Responsibility.
Yeah, that's right. And but the other point is, well, they're not going to make a decision in March because they've got to have their second meeting in March about it. Then they've got to come up with it. There's all sorts of things to consider there, but that kind of brings you back to the fact of, well, where are property investors going in terms of structuring? And people saying landlords are leaving the market. Well, yeah, part-time landlords are leaving the market, but professional landlords are taking up more stock. So the idea that the government is chasing away these landlords, and that's going to mean that there's less amount of supply for the rental, for the PRS, I just don't buy it. I feel that actually there's going to be more stock for rentals because of some of these much bigger institutions coming in and creating stock. Because remember, we're talking about players that make markets here, not just your bog standard landlord. We're talking about pension funds that will create a market rather than wanting to join one. And they have the power to do that.
I'm surprised to see them coming in because the yields are quite low, aren't they?
Yeah, but the yields are low. And this goes back to my earlier point. The yields are low compared to what? Compared to what else is out there now with that same risk parity. The yields aren't low. The yields are low compared to 10, 20 years ago. But compared to what else that they've got to have at the moment, they're actually not bad. And when you compare them to bonds and government bonds and gilts and what have you, they're really not bad. They're pretty good.
Yeah, and you also have to look at it from the point of view of, we are sitting here as professional, sophisticated investors who are seeking a little bit more than a 5% return. And there are other asset classes, let's say equities. Because of the COVID cycle, it's predicted there are going to be a number of businesses that have become zombies and pass away. And the pension funds have got their stockholders' money invested in that. So it'll be a 5% return on nothing, but also actually the fund is worth less because the equity from those shares has evaporated to zero.
I think you bring up a good point, and there is a massive scramble at the moment for yield in a lot of these institutions, a lot of these funds, a lot of portfolios. But I would also challenge you on professional investors wanting a bit more than 5%. I think that's very dependent on what they want to do in terms of risk and effort. And we talked previously about direct versus indirect investment. A lot of these people don't have the time and energy to go around and do what we do, which is being our own asset allocators and asset managers. And I'm not talking about managing sort of lettings, I'm talking about the asset management role of it, which you have to pay someone to do. So a lot of the time, and then there's the risk side of things. So a lot of the time, actually, people will be happy with a 5% return. If someone's got 10 million quid in the bank, and what's more important to them is not losing that 10 million quid or not losing 5% rather than gaining 5%, then you'll find that actually they will be far more willing to go for something like that. Whereas if someone's got 100 grand in the bank, well, then you start to think, well, hold on, if I lose everything, I can go and work minimum wage and save a bit and put it into some slightly risky stuff, and I'll hopefully be back where I was in 5 years' time. So actually losing everything isn't such a drama, and can therefore mean that they can afford to take more risks. So I do think there's, again, going back to this whole difference between sort of where people are, it's like that annoying question people say, if you had £1 million, what would you invest it in? And that's got to be different for everyone, depending on...
It absolutely will. But the
there
other
goes
point
my
which
next
I
question.
think I would elaborate on, the other point I'd elaborate on is, although you might look at something, and I was doing a consultancy with a client literally before we hopped onto this interview, and it had got a 8.4% yield, rising to 9.74 next year because of an RPI linked rent review. So you already knew what it was going to be. So the yield will always increase over time because you've locked in your cash at that price, and the yield will increase as rents rise. But also it does not factor in any potential asset price growth or contraction. And I say growth or contraction because they do go up and down, and it's volatile.
But also factors in deflation. So what happens if RPI goes down? And what happens? Like the big question is, well, who is underwriting this lease? What's the size of their balance sheet? If it's a smaller one, are they a homeowner with a PG? Like what is underwriting that? Because what's the likelihood of the tenant going bust? And then you're left with actually not just no rent, but a liability, having to pay business rates and that sort of thing. So suddenly it's not about something going to zero, it's about something going negative. So there is risk in.
Yeah, you've become negatively geared effectively, where you're paying money out the bank every month opposed to it coming in. In the example that I was looking at with client, it was the NHS. And it's about as good a covenant as you're probably going to get. So from that point of view, yeah.
Unless Nigel gets in, but yeah.
There we go.
Exactly, well, yeah.
I'm conscious we've taken up a huge amount of your time, Rod. I mean, looking back on all that we've covered, what would need to change for you to change your mind on how you're approaching this year? Is there one or two fundamental things that would need to change in order to change your year before we finish for today?
That is a good question. I think if the government called a debt amnesty or something similar, that would definitely change what my thoughts about going forward. If the UK's debasement compared to other Western nations, particularly the US and the rest of Europe, if that went completely out of kilter, that would also affect where I'm at. It could go either way, to be honest, my decision making on that, because again, it depends, like we talked about, property being leveraged equity and commodity, depending on what it is, that could be a benefit potentially. I think that those are the things that factor. Also, if there's a UBI, so universal basic income that gets out to people rather than kind of what's happening at the moment, I think that can affect things as well. I think there's more likely to be kind of wage and CPI increasing, and that could affect things. Also, if it doesn't and there's a deflationary, then yes, then I would have some more concerns about kind of rental and yields as well, and yield shrinking on that front compared to other asset classes as well. So a few different things, but mostly around kind of inflation, deflation, and that type of stuff.
Well, Rod, it's been a phenomenal opportunity to sit here and pick your brains, hear your wisdom, and have David sort of grill you on various matters as we've gone through as well. So thank you very much. If you've loved what Rod has said, drop a comment below. If you disagree with him, pop a comment below and Rod will jump on and debate that point with you. And if you haven't done, hit the thumbs up, because Rod would love to know that you like what he said. And by all means, please subscribe and share with your friends. It's thank you from me, Andrew Roberts. Thank you for Rod Turner for joining us today. And thank you for David Clouter for his expert analysis and input there. All that needs to be said is see you on the next update.
Thanks for having me.